Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Amc Entertainment Holdings Inc. Annual Report. AMC Entertainment Holdings Inc. offers a range of businesses and services through its subsidiaries. At the core of its operations is the theatrical exhibition business, where it owns, operates, or has interests in various theaters across the United States and Europe. This suggests that AMC provides movie theater services to audiences in these regions. The company's extensive network of theaters implies that it offers a variety of amenities and services to enhance the viewing experience for its customers. These may include state-of-the-art sound systems, comfortable seating, concession stands offering food and beverages, and possibly even premium formats like IMAX or 3D screenings. Der Kursverfall der AMC Entertainment Holdings, Inc. Aktie über 65-77% in den letzten 12 Monaten ist ein komplexes Phänomen, des von mehreren Faktoren beeinflusst wird. Einer der Hauptgrund für den Rückgang des Aktienkurses ist die anhaltende Verwässerung der Aktien. Durch die Ausgabe Aktien hat AMC den Markt mit zusätzlichen Anteilen überschwemmt, was zu einer erhöhten Anzahl von Aktien auf dem Markt geführt hat und letztendlich einen Abwärtsdruck auf den Aktienkurs ausübt. Darüber hinaus haben sich die Besitzerzahlen der AMC-Kinos im Vergleich zum Vorjahr fast 10% verringert, was ein erhebliches Problem für Investoren darstellt. Auch wenn die Einnahmen pro Besitzer gestiegen sind, reichen dies nicht aus, den Rückgang der Gesamtbesitzerzahlen zu kompensieren. Die Prognosen des Unternehmens für höhere Nettoverlust im Jahr 2025 haben ebenfalls zum Kursrückgang beigetragen. Zwar der Nettoverlust im vierten Quartal 2025 geringer als erwartet, aber das Gesamtbild der Unternehmensfinanzen bleibt schwierig. Investoren sind auch weiterhin besorgt über die Schuldenlast des Unternehmens und das hohe Verhältnis von Schulden zu Eigenkapital. Darüber hinaus hat sich der Free Cashflow im vierten Quartal 2025 71% verringert, was auf Liquiditätsproblem hinweist. Die allgemeine Marktstimmung rund AMC scheint sich auch zu verschieben. Selbst wenn das Unternehmen die Gewinnerwartungen übertrifft, steigt die Aktie oft nicht, was darauf hindeutet, dass Anleger über kurzfristige Erfolge hinblicken und sich auf fundamentale Probleme konzentrieren. Insgesamt ist der Kursverfall der AMC-Aktie ein komplexes Phänomen, das von mehreren Faktoren beeinflusst wird. Obwohl das Unternehmen im vierten Quartal 2025 besser Umsätze als erwartet meldet und sich optimistisch für 2026 äußert, konnten dies positiven Aspekt die negativen Faktoren nicht ausgleichen. AMC Entertainment Holdings, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $17 billion. AMC Entertainment Holdings, Inc. trades at a lower price-to-book ratio of -0.31 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 121% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the positive side, the company's total revenues increased by 4.3% from $4,637,200,000 in 2024 to $4,848,900,000 in 2025. This growth can be attributed to several key contributors, including a 5.1% increase in U.S. market segment and a 4.6% rise in international market segment. Admissions revenue was a significant contributor to this growth, with an increase of $92 million, 3.5%, from 2024 to 2025. Additionally, food and beverage sales and other ancillary revenues also contributed to the revenue growth. On the other hand, some events and transactions led to revenue decline, such as the equity investments in Hycroft, which resulted in a loss of $34.4 million in 2025. The company's performance was influenced by various factors, including changes in market conditions, customer behavior, and company performance. The resolution of disputes with vendors and the dismissal of ongoing litigation also contributed to revenue growth. However, the net operating loss carryforwards decreased by $41.4 million in 2025 compared to 2024, indicating a decline in certain areas. Overall, the primary drivers of revenue growth or decline were influenced by a combination of factors, including changes in market conditions and company performance. The net income of a company underwent significant fluctuations between 2023 and 2025. Initially, it increased by $200,000 from 2023 to 2024. However, this trend was short-lived, as net income decreased by $56.7 million in 2024 compared to 2025 due to changes in estimated fair value of new exchangeable notes. Furthermore, the company reported a net loss that increased from $352 million, 2024 to $632 million, 2025. The decrease in net income was also attributed to increases in interest expense from higher market interest rates. Profit margins also experienced changes during this period. While there were instances of possible increase and decrease in profit margins, the overall trend showed a decline. For instance, operating margin decreased from 2.48% to 0.36%. The company's U.S. markets saw an increase of plus 15%, while international markets witnessed a minus 2% decrease. Attributable EBITDA increased from $1.9 million to $2.3 million, but impairment losses were on the rise. The reasons behind these changes in net income and profit margins are multifaceted. Supply chain disruptions and labor shortages led to increased costs, which negatively impacted profit margins. Additionally, higher market interest rates resulted in increased interest expense, further contributing to the decline in net income. The company's North America box office grosses were also down approximately 22% for the year ended December 31, 2025 compared to the year ended December 31, 2019. In conclusion, the fluctuations in net income and profit margins between 2023 and 2025 can be attributed to various factors such as supply chain disruptions, labor shortages, higher market interest rates, and decreased box office grosses. These changes had a significant impact on the company's financial performance, resulting in increased losses and decreased profitability. The financial health of a company can be determined by its ability to generate positive operating cash flow. Operating cash flow refers to the amount of money a company generates from its core business operations. In this case, the extracted summaries reveal that the company is struggling to achieve this milestone. According to various pages in the report, the company's operating cash flow has been consistently negative over the past 2 years. For instance, page 61 shows an operating cash flow of minus $119,800,000 for the year 2025, while page 68 confirms a net cash outflow from operating activities of minus $119.8 million. Furthermore, pages 78 and 79 provide additional evidence of negative operating cash flows in both 2024 and 2025. The conclusion drawn from these summaries is that the company is not generating positive operating cash flow. This is a concerning trend that may indicate underlying issues with the company's business model or financial management. The company's debt level and interest expenses have undergone significant changes in recent years. In terms of debt level, the total debt has decreased from $4,024.2 million in 2025 to $58.9 million in 2024. However, this decrease is offset by an increase in debt due to the exchange of existing 7.5% notes for new 2029 notes. The principal amount of corporate borrowings also increased from $4,134.50 to $4,024.20. Regarding interest expenses, there has been a notable increase. Interest expenses have risen due to new term loans with unspecified interest rates and the amortization of unamortized discounts and deferred charges related to term loans due 2026. Specifically, interest expense increased by approximately $43.6 million, or 12.7%, from 2024 to 2025. Overall, while the total debt level has decreased, the increase in debt due to new notes and the rise in interest expenses suggest that the company's financial obligations have become more complex and costly. The performance of various segments and regions in the market can be summarized as follows. In terms of strong performance, the top-performing U.S. markets include California, Florida, Texas, New York, and New Jersey, which consistently ranked high throughout the year. Los Angeles and New York emerged as the top two markets for the year ended December 31, 2025. Internationally, the United Kingdom showed impressive attendance numbers with 123.5 million visitors in 2025, while Norway experienced a slight increase in attendance. On the other hand, certain regions struggled to keep pace. In the U.S., Arkansas, Idaho, Nebraska, North Dakota, and South Carolina were among the underperforming markets. Internationally, Spain saw a decline in attendance with 65.1 million visitors in 2025, while Sweden also experienced a decrease with 9.7 million attendees. Germany ranked fourth as an operator but struggled to maintain its position. Additionally, Italy, Portugal, and Denmark faced challenges in the market. It's worth noting that some regions incurred impairment losses due to underperformance. These include Germany, Italy, Spain, Sweden, and the UK internationally, as well as U.S. markets with screens in specific states not listed. AMC Entertainment's management outlook and strategy management at AMC Entertainment is facing significant financial challenges, including high debt levels, cash burn rates, and declining revenue. To address these issues, the company has taken steps to restructure its debt by issuing new exchangeable notes with lower interest rates and increased flexibility in repayment terms. The management team is prioritizing cash flow management, aiming to achieve net positive cash flows from operating activities by increasing revenues to pre-COVID-19 levels. This includes investing in technology to improve the customer experience, such as recliner seats and enhanced food and beverage options. In addition to managing its financial challenges, AMC Entertainment is also exploring strategic partnerships with other companies to drive growth and increase revenue. The company is focusing on customer retention strategies, including loyalty programs and rewards redemption rates, to maintain a loyal customer base. Overall, the management team's strategy is centered around managing financial challenges, investing in technology, and driving growth through strategic partnerships. By prioritizing cash flow management and increasing revenues, AMC Entertainment aims to return to profitability and achieve long-term sustainability. The acquisitions and divestitures made by the company are notable transactions that have shaped its business landscape. On the acquisition front, one significant deal was the purchase of Odeon Cinemas Group, although the exact date is not specified in the records. This move likely expanded the company's presence in the cinema industry. In addition to this major acquisition, the company also made a 10% investment in Saudi Cinema Company, LLC. However, it's worth noting that this investment was later sold, indicating a strategic decision to divest from this particular venture. On the divestiture side, the company sold its 10% stake in Saudi Cinema Company, LLC, marking a reversal of its earlier investment. Furthermore, the sale of Hycroft common stock and warrants for $24.1 million also represents a significant divestment transaction. These moves suggest that the company is actively managing its portfolio and making strategic decisions to optimize its investments. The company's financial activities have been notable in recent times. One significant move was the payment of a special dividend, which demonstrates the company's commitment to returning value to its shareholders. This decision shows that the company is confident in its financial position and is willing to share some of its profits with investors. In addition to paying dividends, the company has also taken steps to manage its capital structure through a reverse stock split. By buying back shares, the company has reduced the number of outstanding shares on the market, which can have a positive impact on earnings per share and overall stock price. This strategic move highlights the company's focus on optimizing its financial performance and creating value for shareholders. There are concerns about inventory buildup and supply chain disruption in the motion picture industry. the potential for supply chain disruptions poses a significant risk to operating results, as highlighted on page 20. This is particularly relevant given the industry's reliance on labor that is subject to collective bargaining agreements, which can lead to production delays if timely agreements or renewals are not reached. The dependence on these agreements further exacerbates the risk of supply chain disruption, as seen on page 24. Moreover, the potential for increased costs and limited availability of critical products due to supply chain risks could have a significant impact on the industry's operations, as noted on page 26. That concludes the financial summary for Amc Entertainment Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.